Business owners, I need you to stop saying these 4 words. It's a tax write-off. You spend $10,000 on something you don't really need because someone tells you, don't worry, you can write it off. But here's what they forgot to tell you. A $10,000 tax deduction does not put $10,000 back in your pocket. You still spent the money, and misunderstanding this could be costing your business thousands of dollars. Hi, I'm Us Melbourne, founder of Melbourne Accounting Solutions. Today, we're going to clear up one of the biggest misconceptions I hear from business owners. What does a tax write-off actually mean? Because a tax deduction can reduce taxable income, but it does not normally mean the government reimburses you for everything you spent. Let me show you. The $10,000 example. Imagine your business is considering purchasing something that cost $10,000. You don't really need it, but someone says, buy it. It's a business expense, you'll get it back on your taxes. That's not how it works. Let's use a deliberately simplified example. Suppose the entire $10,000 were deductible immediately, and suppose, purely for illustration, the applicable tax rate were 20%. A $10,000 deduction could reduce the tax in that simplified example by approximately $2,000. But you still spent $10,000. You didn't make $8,000. You spent $10,000 to potentially save $2,000 of tax. So if the purchase didn't help your business, you may have spent $10,000 unnecessarily just to avoid approximately $2,000 of tax. That's not tax planning. That's poor financial decision making. What a tax deduction actually does at a basic level. An allowable business expense generally reduces the income on which tax is calculated. For example, revenue, $200,000 allowable expenses, $120,000 income before considering other relevant tax adjustments, $80,000. If the business incurs another qualifying $10,000 expense, that may reduce the relevant income to $70,000. You're generally paying tax based on a lower amount. But here's the important part. You still had to spend the $10,000. That's why the first question shouldn't be, can I deduct it? The first question should be, does my business actually need it? Then we consider the tax treatment. And not everything is 100% deductible. This is another mistake business owners make. Just because something relates to your business doesn't necessarily mean the entire amount receives an immediate deduction. Different rules can apply. Meals and entertainment expenses can be subject to limitations. Vehicles can have restrictions and business versus personal use considerations. Capital assets, such as equipment, may generally be deducted over time through the applicable capital cost allowance rules, rather than simply being treated like an ordinary expense. Certain expenses may not be deductible at all, and personal expenses don't become business expenses simply because you paid for them using the company credit card. Tax treatment depends on what you purchased, why you purchased it, and the applicable rules. This becomes especially dangerous near year-end. A business owner hears, you made a lot of money this year, you need more expenses. So suddenly, they're buying computers, furniture, equipment, vehicles, subscriptions, and things the business wasn't even planning to purchase. But I want you to remember something. Paying tax on profit isn't necessarily a bad thing. Profit means your business made money. The objective of tax planning isn't to eliminate profit by spending everything you earned. The objective is to structure your affairs appropriately, claim legitimate deductions, take advantage of available planning opportunities, and still build a financially strong business. Never spend $1 unnecessarily just to save a fraction of that dollar in tax. Make the business decision first, then optimize the tax treatment, not the other way around. 3 questions before a business purchase, before making a major purchase, primarily because of the potential tax deduction. Ask yourself, number 1, would I still buy this if there were no tax deduction? If the answer is no, reconsider why you're buying it. Number 2, How will this purchase help my business make money, save money, or operate better? There should be a business reason. Number 3, what is the actual after-tax cost? Don't guess, run the numbers. That's how business owners should think. At Melbourne Accounting Solutions, our goal isn't simply to find expenses so you can pay less tax. Our goal is to help you keep more of what your business earns while making financially sound decisions. Tax planning should work together with cash flow planning, profitability, investment decisions, owner compensation, and your long-term business goals. So before making a major purchase, simply because somebody told you it's a write-off, contact Melbourne Accounting Solutions. Let's determine what the purchase could actually save in tax and whether spending the money makes financial sense in the first place. Here's today's CEO question. Would I still make this purchase if the CRA gave me absolutely no tax deduction for it? If the answer is no, think very carefully before spending the money. I'm Everald Melbourne, founder of Melbourne Accounting Solutions. Our mission is simple: to help Canadian business owners make smarter financial decisions, reduce unnecessary taxes, and build stronger businesses. If you found this lesson valuable, please subscribe to our channel so you never miss future Canadian business, tax, accounting, and financial insights designed to help you succeed. And before making a major business purchase purely for the tax deduction, contact Melbourne Accounting Solutions. Let's run the numbers first and make sure the decision makes sense for your business, not just your tax return. Helping Canadian business owners learn, grow, prosper. Thanks for watching, and I'll see you in the next lesson.